Silver prices have exploded through the critical $100 barrier, reaching $102 per ounce, while January futures open interest has doubled within just 5 trading days. This isn't ordinary market volatility or speculative enthusiasm driving price movements higher. This represents fundamental structural changes in silver market dynamics that suggest a genuine supply squeeze may be developing with mathematical inevitability. The doubling of open interest in such a compressed timeframe indicates massive new positioning that goes far beyond normal trading activity or seasonal patterns. Understanding what open interest doubling actually means requires examining the mechanics of futures markets and delivery obligations. Open interest represents the total number of outstanding futures contracts that remain open and have not been closed or delivered. When open interest doubles in 5 days, it means market participants have committed to buying or selling twice as many contracts as existed previously. This dramatic increase suggests either massive new speculative interest or, more concerning for the paper market, substantial new demand for physical delivery that cannot be satisfied through normal market operations. The critical distinction lies in the nature of this new positioning. Speculative trading typically involves frequent position changes as traders attempt to profit from price movements without intending physical delivery. Mandatory purchases driven by physical demand create entirely different market dynamics because these buyers cannot accept cash settlement as substitute for actual metal delivery. Industrial users, jewelry manufacturers, and investment funds seeking physical silver must take delivery regardless of price or market conditions. COMEX warehouse data reveals the supply-side fragility that makes current conditions particularly dangerous for short position holders. Registered silver inventories available for immediate delivery have declined to multi-year lows, while total open interest represents claims on silver quantities that far exceed available physical inventory. The mathematical impossibility becomes apparent when examining delivery capacity relative to potential demand from new position holders. Current registered silver inventories at COMEX warehouses total approximately 25 million ounces, while total open interest exceeds 600 million ounces of silver claims. If even 5% of contract holders demand physical delivery, the exchange faces an impossible situation with insufficient inventory to satisfy delivery obligations. This mathematical constraint creates systematic pressure that can force dramatic price increases as the exchange seeks to discourage delivery demand through higher prices. The rapid decline in available inventory occurs simultaneously with increasing delivery requests from market participants who no longer trust paper claims and seek physical possession. This combination creates what market analysts describe as a delivery squeeze, where the exchange must choose between defaulting on delivery obligations or implementing emergency measures, including forced cash settlement at artificially suppressed prices that could trigger legal challenges and destroy market credibility. Industrial demand for silver creates additional pressure that operates independently from investment considerations and cannot be reduced through higher prices. Electronics manufacturers require silver for conductivity applications that have no practical substitutes at any price level. Solar panel production consumes substantial silver quantities for photovoltaic cells, where alternative materials compromise efficiency and long-term performance. Medical device manufacturing utilizes silver's antimicrobial properties for surgical instruments and implants, where substitution risks patient safety. The inelastic nature of industrial demand means that manufacturing companies must secure silver supplies regardless of price increases because production disruption costs exceed metal cost increases. This creates baseline demand that cannot be eliminated through price rationing mechanisms that work for speculative or investment demand. Industrial users often accelerate purchases when supply concerns develop, adding additional demand pressure during exactly the periods when supply becomes most constrained. Geopolitical risks have intensified silver demand through multiple channels, including safe haven investment flows and supply chain security concerns. Military conflicts affect mining operations and transportation networks while creating defense industry demand for silver-containing electronic systems. Economic sanctions fragment international trade relationships and encourage diversification away from dollar-denominated assets toward physical commodities, including precious metals. The weaponization of currency systems and payment networks has accelerated institutional movement toward neutral assets that cannot be frozen or confiscated through financial sanctions. Silver provides portable wealth storage that remains accessible regardless of political relationships or banking system stability. These geopolitical premiums operate independently from traditional supply-demand fundamentals and can persist for extended periods during international tension. Export restrictions imposed by major silver-producing nations create additional supply constraints that compound existing inventory pressures. China, Peru, and Mexico have implemented various restrictions on silver exports designed to support domestic industrial users and strategic reserves. These restrictions reduce global supply availability while creating regional price disparities that encourage further hoarding behavior by consumers concerned about future access. The compounding effect of simultaneous supply restrictions from multiple producing regions creates global shortages that cannot be easily resolved through increased mining production. Silver mining projects require years of development and substantial capital investment before generating meaningful production increases. Even dramatic price increases provide limited immediate supply response because mining operations face permitting delays, equipment shortages, and technical challenges that prevent rapid capacity expansion. Market structure changes have created additional vulnerabilities that amplify squeeze potential beyond what historical precedents might suggest. The concentration of silver trading through electronic platforms and algorithmic systems creates feedback loops where price advances trigger additional buying from momentum-following strategies. Exchange-traded funds and structured products linked to silver prices face redemption pressures that force additional physical purchases exactly when inventory becomes most scarce. High-frequency trading systems often incorporate momentum indicators and breakout strategies that generate additional buying pressure when prices exceed significant technical levels. The psychological impact of $100 silver creates media attention that attracts retail investor interest while potentially triggering algorithmic buying from systems programmed to follow trend-following strategies. These systematic buying programs operate independently from fundamental analysis and can continue purchasing even when prices reach seemingly irrational levels. The options market dynamics add another layer of complexity to current squeeze conditions through gamma hedging requirements that force additional futures purchases. Large options positions approaching expiration require hedging through underlying futures contracts to maintain risk neutrality. When silver prices advance rapidly, options market makers must purchase additional futures contracts to hedge their exposure, creating additional buying pressure that amplifies the original price movement. Margin requirements and financing costs create additional squeeze mechanics for participants holding short positions in volatile markets. As silver prices advance, short position holders face increasing margin calls that require additional capital commitment or position closure through covering purchases. When multiple short holders attempt to close positions simultaneously, their covering purchases accelerate price advances that trigger additional margin calls in cascading cycles that can overwhelm normal market liquidity. The international dimension of silver markets complicates squeeze resolution because supply and demand imbalances can persist across different geographic regions and regulatory jurisdictions. London silver markets may experience different supply pressures than New York markets due to transportation costs, insurance requirements, and regulatory differences. These geographic arbitrage opportunities normally help balance global markets, but can break down during extreme conditions when normal arbitrage mechanisms become economically unviable. Central bank responses to precious metals market disruption remain uncertain because traditional monetary policy tools may prove ineffective during supply-driven price advances. Interest rate changes that normally influence speculative demand have limited impact on industrial demand or supply-driven shortages. Quantitative easing programs that increase liquidity might actually accelerate precious metals demand by undermining currency confidence rather than providing market stability. The banking sector's exposure to silver price movements through derivative positions creates potential systemic risks that could affect broader financial system stability. Major commercial banks maintain substantial short positions in silver derivatives that generate losses when prices advance rapidly. These derivative losses can affect bank capital adequacy and lending capacity, while potentially requiring emergency intervention if losses threaten systemically important financial institutions. Historical precedents provide context for understanding potential squeeze magnitude and duration, while recognizing that current conditions differ significantly from previous episodes. The 1979-1980 silver surge saw prices advance from $6 to $50 within 18 months before regulatory intervention and margin requirement increases ended the advance. The Hunt brothers' attempt to corner silver markets demonstrated both the potential for dramatic price appreciation and the eventual intervention measures that regulators implement when precious metals markets threaten broader financial stability. However, current conditions differ from historical episodes because they involve systematic supply-demand imbalances rather than speculative manipulation attempts. Industrial demand provides fundamental support that was absent during previous speculative episodes, while supply constraints result from structural mining and geopolitical factors rather than artificial hoarding. These differences suggest that regulatory intervention might prove less effective, while squeeze resolution requires actual supply increases or demand destruction rather than simply eliminating speculative excess. The regulatory framework governing commodity markets has evolved since previous precious metals crises, but faces challenges when dealing with supply-driven shortages versus speculative bubbles. Position limits and margin requirements can reduce speculative activity, but cannot address fundamental supply-demand imbalances that drive industrial and investment demand. Emergency measures including trading suspensions or forced cash settlement risk, undermining market integrity, and encouraging even greater physical demand from participants who lose confidence in paper markets. Technology sector implications deserve particular attention because electronics manufacturing represents the largest industrial silver consumption category and cannot easily reduce usage when prices increase. Semiconductor production requires silver for various applications, including conductivity, thermal management, and component manufacturing. Consumer electronics production faces cost pressures from higher silver prices, but cannot substitute alternative materials without compromising product performance and reliability. The automotive industry's transition toward electric vehicles creates additional silver demand that compounds existing supply pressures. Electric vehicles require substantially more silver than traditional gasoline vehicles for battery systems, electric motors, and charging infrastructure. The global push toward transportation electrification ensures continued demand growth that operates independently from price considerations because automotive manufacturers cannot easily delay production schedules or substitute inferior materials. Renewable energy sector demand provides another source of inelastic silver consumption that supports higher prices during supply shortage periods. Solar panel manufacturing consumes substantial silver quantities for photovoltaic cell production, where alternative materials reduce efficiency and long-term durability. Wind power generation requires silver for electronic control systems and power transmission components. Energy storage systems utilize silver for various battery technologies and power management applications. Medical device manufacturing creates additional demand that cannot be reduced without compromising patient safety and regulatory compliance. Surgical instruments require silver coating for antimicrobial properties that prevent infection and ensure sterile conditions. Medical implants incorporate silver components for biocompatibility and long-term performance in human body environments. Hospital equipment utilizes silver for various applications, including infection control systems and diagnostic equipment components. The jewelry industry represents a significant demand source that shows price sensitivity but cannot eliminate silver usage completely without fundamentally changing product characteristics. While jewelry demand may decline when silver prices increase dramatically, luxury applications and cultural traditions often maintain demand regardless of cost considerations. Additionally, jewelry manufacturers often accelerate purchases during price advances to secure inventory before further increases, creating temporary demand acceleration that compounds supply pressures. Investment demand from institutional and retail participants creates additional complexity because it responds to both price momentum and supply shortage concerns. Exchange-traded funds tracking silver prices face redemption pressures that force physical purchases when investor interest increases during price advances. Individual investors seeking portfolio protection or precious metals exposure often increase purchases when supply shortage stories receive media attention, creating self-reinforcing demand cycles. The storage and logistics infrastructure for physical silver faces capacity constraints that compound delivery squeeze pressures. Vault operators experience increased demand for storage services when investors seek physical possession rather than paper claims. Transportation companies face higher insurance costs and security requirements when moving valuable cargo during volatile market conditions. These logistical bottlenecks can delay delivery even when physical metal becomes available for purchase. International trade finance complications affect silver markets when traditional banking relationships face disruption from geopolitical tensions or sanctions regimes. Letters of credit and trade financing arrangements may become unavailable for silver transactions involving certain countries or companies. These financing disruptions can restrict normal trade flows and create regional supply imbalances that persist longer than fundamental supply-demand conditions would suggest. Currency market volatility adds another dimension to silver squeeze dynamics because mining costs, transportation expenses, and international trade arrangements all depend on stable exchange rates. When major currencies fluctuate dramatically, it affects both silver supply economics and demand patterns from different geographic regions. Currency instability often increases precious metals demand, as investors seek alternatives to devaluing paper currencies, adding additional demand pressure during already tight supply conditions. The derivatives market structure creates potential amplification mechanisms that could accelerate squeeze conditions beyond what physical supply-demand fundamentals alone would generate. Complex financial instruments linked to silver prices, including structured notes, commodity-linked bonds, and various hedging products, may require physical backing or hedging through futures markets when prices move dramatically. These derivative positions can create additional demand for physical silver or futures contracts that compounds underlying shortage pressures. Risk management systems at financial institutions may trigger additional position changes when silver price volatility reaches extreme levels. Value-at-risk models and other risk metrics often require position reductions or hedging adjustments when price movements exceed predetermined parameters. These systematic responses can create additional buying or selling pressure that amplifies the original price movements and extends squeeze duration beyond what fundamental factors alone would support. The psychological aspects of market squeezes create momentum effects that can sustain price advances longer than economic fundamentals would justify. Fear of missing out drives additional buying from participants who observe rapid price advances and worry about continued appreciation. Short covering activity accelerates as position holders recognize that squeeze conditions make maintaining bearish positions increasingly dangerous and expensive. Media coverage patterns during squeeze periods often focus on dramatic price movements and supply shortage stories that attract additional public attention to silver markets. Mainstream financial media coverage of precious metals typically increases dramatically when prices reach new highs or approach psychologically significant levels. This increased coverage can attract retail investor interest that adds additional demand pressure exactly when supply constraints are most severe. Social media amplification of squeeze narratives can accelerate retail investor participation and create viral momentum that spreads beyond normal precious metals investor communities. Online discussions about supply shortages and delivery problems can encourage additional physical purchases from individuals who normally maintain limited precious metals exposure. These social media effects operate faster than traditional media coverage and can create rapid demand surges that overwhelm normal market capacity. Professional investor responses to squeeze conditions vary depending on their existing positioning and risk management requirements. Hedge funds may increase precious metals exposure when momentum indicators suggest continued advances while simultaneously implementing hedging strategies to limit downside risk. Pension funds and insurance companies often maintain strategic precious metals allocations, but may face constraints on increasing exposure during volatile periods due to regulatory or policy limitations. The timing considerations for squeeze resolution depend on multiple factors, including regulatory intervention potential, supply response timing, demand destruction possibilities, and broader economic conditions. While squeezes can persist longer than participants expect, they eventually resolve when supply increases, demand decreases, or regulatory intervention changes market structure. Understanding these resolution mechanisms helps market participants evaluate both opportunity and risk during squeeze conditions. This analysis examines observable market conditions and structural factors rather than predicting specific price movements or providing investment advice. Silver market squeezes represent complex phenomena involving multiple interacting factors that can evolve unpredictably. Understanding these dynamics provides context for evaluating current conditions, while recognizing that market outcomes remain inherently uncertain regardless of apparent supply-demand imbalances or technical indicators suggesting continued price advances.